Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Novo Nordisk.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Absolutely.
So today our mission is to really understand the incredibly turbulent, yet absolutely fascinating landscape of the leading giant in the pharmaceutical weight loss and diabetes space.
It's definitely been a turbulent stretch recently.
Right. We're looking at a company that has experienced these massive recent price drops, executed some gigantic supply chain acquisitions, and, well, they're sitting at a very pivotal crossroads for the next few years.
A very pivotal crossroads.
Yeah. And if you are an investor looking at your portfolio, or even just someone watching the broader healthcare market, you need to understand the underlying mechanics of what is actually happening here. We're going to explore the wealth-building context behind their recent moves, the intense competition they face, and what the next few years hold. Let's just get right into the data.
Sounds good. The current situation presents a highly complex picture. The market is experiencing severe whiplash right now, driven by a company that is essentially restructuring its entire operational footprint while simultaneously navigating some of the most intense pricing and competitive pressures we have seen in modern pharmaceuticals.
Right.
But to really understand the future trajectory, we have to establish a baseline of where they currently stand.
I was actually looking at the broad performance metrics from 2025 before we started, and the sheer scale of the revenue is, frankly, difficult to comprehend.
It is massive.
But it also seems dangerously concentrated in just one primary segment. Can we break down those numbers for the listener to set the stage?
Certainly. So last year, the company reported total revenue of 309 billion Danish kroner.
Okay, let's translate that for a second. That's roughly, what, 45?
That translates to roughly 45.9 billion US dollars.
45.9 billion. Wow.
Exactly. And the concentration you mentioned is the critical factor for investors to watch here. Over 90% of that massive revenue figure came directly from their diabetes and obesity care segment.
90%.
Over 90%. We are talking about three absolute powerhouse products driving the entire machine: Ozempic, Rybelsus, and Wegovy. These drugs completely dominate the GLP-1 market.
You know, before we go further into the financials, let's make sure we define that term for anyone who only knows the brand names. When we say GLP-1, what mechanism are we actually talking about from a medical and market perspective?
GLP-1 stands for glucagon-like peptide 1. In simple terms, it's a hormone that your body naturally produces in the gut when you eat.
Okay.
It tells your pancreas to release insulin, which regulates blood sugar, and crucially, it signals to your brain that you are full. The drugs we are discussing are synthesized versions of this exact hormone.
So they essentially trick the brain.
Basically, yes. They keep that fullness signal active much longer than your natural biology would, which dramatically reduces appetite and leads to significant weight loss. Because the results are so visibly effective, the consumer demand has been entirely unprecedented in the history of pharmaceutical launches.
And that brings us to the core mystery of their recent stock performance. If they are pulling in nearly $46 billion and dominating a market with unprecedented consumer demand, the 2026 guidance they just released seems, well, entirely contradictory. They issued a massive guidance shock.
They delivered a shockingly cautious forecast for 2026. Management is projecting an adjusted sales decline of -5% to -13%, assuming constant exchange rates.
-5 to -13%.
Yes. For a company that has enjoyed explosive, sustained growth over the past few years, forecasting a double-digit revenue decline is a severe reality check for institutional and retail investors alike.
As an investor, seeing a projected double-digit decline in a booming industry is a huge red flag. What are the specific mechanisms driving that contraction? I mean, how do you lose that much ground when everyone seemingly wants your product?
The contraction is being driven by a perfect storm of systemic headwinds in the U.S. healthcare market. First, you have intense U.S. pricing pressures, specifically driven by most favored nation deals.
Let's pause there and unpack that concept because it's important. How does a most favored nation deal actually force a pharmaceutical giant to lose money?
It doesn't necessarily force them to lose money, but it aggressively compresses their profit margins. A most favored nation, or MFN clause, essentially dictates that if a pharmaceutical company negotiates a deep discount on a drug with one specific healthcare provider or insurer,
They have to give it to everyone else.
They are legally obligated to offer that exact same rock-bottom price to the government programs or other major entities holding the MFN contract. It creates a cascading effect. You can no longer segment your pricing. Your lowest discounted price essentially becomes your standard price across vast swaths of the market.
That is a brutal mechanism for profit margins. And I understand Medicaid cuts are also playing a role in this margin compression.
Yes, they are. Medicaid programs are reducing their reimbursement rates for these specific treatments. When government programs pay less per dose, the manufacturer has to absorb that difference if they want to maintain patient access.
Right.
Historically, this company has operated with phenomenal efficiency, enjoying profit margins above 80%.
80% margins are incredible.
They are. But when you combine the MFN deals, the Medicaid reimbursement cuts, and the heavy integration costs from their recent acquisitions, those 80% margins face severe downward pressure.
And the market clearly did not like that reality check. The stock took an immediate 18% plunge. An 18% drop for a global titan of this size is a seismic event. It completely broke below key support levels on the trading charts, which usually signals full-on panic.
The sharp sell-off post-guidance strongly suggests psychological exhaustion among investors. They were modeled for boundless growth, and the sudden shift to margin compression and sales declines triggered a mass exit.
A rush to the doors.
Exactly. However, when a fundamentally strong company experiences an 18% drop based on forecasted margin compression rather than a structural failure of their product, you start looking at the technical analysis. The stock trading near these recent lows points to a potential capitulation phase.
Let's translate capitulation phase into a wealth-building context for a second. Are we talking about the moment where all the panicked sellers finally run out of shares to dump?
Precisely. Capitulation is the point of maximum market pessimism. It is the moment when the last of the nervous investors sell their positions at a loss just to get out. Once that heavy selling volume is flushed through the system, it establishes a theoretical floor.
So it's a buying opportunity.
For an investor, this represents an opportunity for a momentum reversal. You watch the charts for the formation of higher lows, meaning each subsequent dip in the stock price doesn't fall quite as far as the previous one. It signals that buyers are stepping back in and stabilizing the asset.
So while the retail market is panicking over short-term guidance, we need to look at how management is actually deploying the massive cash reserves they built up in 2025. Because they are pouring robust free cash flow into aggressive vertical integration right now. They just executed an $11.7 billion acquisition of Catalent's fill-finish sites, alongside a $4.7 billion deal for Akero Therapeutics.
Those acquisitions represent a massive strategic shift from simply creating a drug to controlling the entire physical infrastructure of its delivery. But the terminology can be dense. Let's look at the Catalent acquisition specifically.
Right, let's break down why an investor should care about fill-finish sites. If I can use an analogy here to see if I am viewing this correctly.
Go ahead.
Imagine you invent the world's most popular soda. Demand is off the charts, but you don't actually own the bottling plants. You rely on third-party factories to put your soda into the glass bottles, and suddenly there's a global glass shortage. You are entirely at the mercy of your contractors, limiting how much you can sell. Did this company essentially just spend nearly $12 billion to buy the bottling plants?
That analogy perfectly captures the strategic intent. In pharmaceutical manufacturing, a fill-finish site is exactly that. It's the highly specialized, sterile factory where the raw liquid medication is carefully measured and filled into the final syringes or injection pens and then packaged for the consumer.
The bottleneck.
It is the most critical bottleneck in the entire supply chain. By purchasing Catalent's sites for nearly $12 billion, they are securing their supply chain against surging global demand and dramatically reducing their reliance on contract manufacturing organizations.
That changes the equation completely. It moves them from just having a patent on a chemical to having a physical monopoly on production.
It creates an incredibly deep intellectual property moat. Their primary defense has always been their patents on the semaglutide molecule itself. But now they have combined that chemical IP moat with a vertically integrated physical supply chain. It is a defensive fortress against massive competitors.
Right.
But the strategy extends beyond just the manufacturing of the pens. Management refers to their broader strategy as owning the patient journey.
Now, owning the patient journey sounds a bit like marketing speak. How does that translate into actual revenue streams and label expansions for these drugs?
It translates into proving that these drugs do far more than just suppress appetite. They're actively running clinical trials to expand their official FDA drug labels to treat a broad spectrum of interconnected metabolic diseases. They are targeting MAH, which is a severe progressive liver disease characterized by dangerous fat buildup and inflammation. They are targeting chronic kidney disease, or CKD. They are even targeting HFpEF.
Let's define HFpEF because heart failure is a terrifying prospect, but that acronym is very clinical.
HFpEF stands for heart failure with preserved ejection fraction. Essentially, the heart muscle pumps normally, but it has become too stiff to fill with blood properly between beats. It is a severely debilitating condition, often linked to metabolic issues and obesity.
Okay.
By expanding their drug labels to officially treat MASH, CKD, and HFpEF, they fundamentally alter the commercial value of the drug.
I see the wealth-building context there. Because if it is just a weight loss drug, insurance companies can argue it is a lifestyle treatment and simply refuse to cover it. But if the FDA says this drug prevents heart failure and saves the liver, the insurers have no choice but to pay for it.
That is the exact financial mechanism at play. To give you a sense of scale, the potential for Wegovy's approval to treat MASH alone is projected to exceed $1 billion in new sales. They are transforming the product into the foundational treatment for a patient's entire metabolic health life cycle.
I am looking at that strategy and wondering about the financial risk, though. Spending over $16 billion on factories and biotech acquisitions, while simultaneously expanding massive clinical trials and facing U.S. margin compression, that seems like a recipe for a cash flow crisis. How is their balance sheet holding up?
It's a vital question for any long-term investor. The reality is that these expensive acquisitions are indeed pressuring their temporary cash flow. However, their balance sheet remains structurally stable. The free cash flow generation from their core GLP-1 franchise is so immense that it easily absorbs this massive reinvestment phase.
So they can afford the hit.
Absolutely. The debt load is entirely manageable given their cash reserves. Furthermore, the company continues its shareholder returns via regular dividends. They operate under a Danish social responsibility model, which prioritizes long-term sustainable growth while still providing consistent capital returns to the current shareholders, even during heavy investment cycles.
So the financial foundation is solid, and they are building a vertically integrated fortress.
Yeah.
But you don't build a fortress unless you are preparing for a siege. The pharmaceutical battlefield is getting incredibly crowded. Eli Lilly is obviously the primary rival with their drug, tirzepatide. But who else is threatening this market share?
Eli Lilly is the heavyweight challenger, but the arms race involves several major players. Roche is trailing slightly behind with an experimental drug called petrelintide. Pfizer is making aggressive moves internationally. Their China-cleared drug, ecnoglutide, recently demonstrated a highly competitive 15.4% weight loss in trials.
15.4% is huge.
It is. Furthermore, you have companies like Viking Therapeutics pushing hard to develop oral alternatives, aiming to eliminate the need for injections entirely.
In the middle of this arms race, we saw a highly publicized event that analysts are calling the CagriSema incident. I want to dig into this because the market reaction seemed entirely counterintuitive.
Yes, that was an interesting moment.
They ran a phase 3 trial for a treatment called CagriSema, pitting it directly against Eli Lilly's offerings, and the trial failed. On paper, a phase 3 failure against your biggest rival should be a catastrophic blow to the stock. Yet, the market unexpectedly positioned Novo Nordisk as a surprise winner. Can you provide the actual contextual why behind that market reaction?
It requires looking past the immediate headline. CagriSema was an experimental combination therapy, meaning they were combining multiple active molecules to try and force even greater weight loss to beat Eli Lilly's numbers.
Pushing the limits.
Right. When the trial failed, it actually highlighted a critical underlying reality of the market. Pushing human biology too hard with aggressive combination therapies introduces harsh, intolerable side effects. The failure essentially proved that chasing higher percentage weight loss at the expense of patient safety is a dead end.
So by failing with the aggressive combo, the market realized their original single-molecule drug is actually the safest long-term option.
Exactly the market realization. It highlighted the underlying strength and safety profile of their core GLP-1 drug. Patients need to be on these medications for years, perhaps for life. Tolerability is ultimately more valuable than raw, aggressive weight loss.
That makes total sense.
The failure also forced management to pivot their research capital away from the redundant combination therapy and direct it toward their much more promising oral pipeline. The market digested the failure and concluded that the core business remains uniquely insulated against competitors who are risking harsh side effects to compete on percentages.
That is a fascinating example of how institutional investors read clinical data differently than the general public. Speaking of regulatory environments, there was a massive catalyst that just dropped on March 3rd involving the FDA. The FDA sent official warning letters to a whole host of telehealth providers. What is the core wealth-building takeaway from that specific intervention?
The takeaway revolves entirely around pricing power and market share protection. When the demand for these drugs vastly outstripped the supply over the last few years, a massive gray market emerged. Telehealth providers began selling compounded off-brand versions of the medication. They were essentially mixing cheap copycats to fill the void left by manufacturing shortages.
And the telehealth providers were making an absolute fortune doing it.
They were. But by stepping in on March 3rd and sending those warning letters, the FDA is systematically shutting down that gray market. By curbing the cheap copycats, the FDA is essentially acting as a protective regulatory barrier for the branded company.
All right, because the patients still need the medication.
Exactly. If patients can no longer easily acquire cheap compounded versions through an app, they are forced back into the traditional medical system to purchase the branded, patent-protected product. This directly reinforces their pricing power and helps mitigate the margin compression we discussed earlier.
Let's pull all these threads together and look at how the smart money is behaving. We have an 18% stock drop, cautious guidance, massive acquisitions, intense competition, and FDA interventions.
If we look at institutional flow, the overall news mood is currently graded as neutral. But there was a very striking public display of conviction on March 5th.
Yes, top investor Karen Firestone was observed buying more of this specific stock live on CNBC. Seeing a highly respected institutional investor buying the stock on live television right near the absolute bottom of an 18% plunge feels like a massive signal to the broader market.
It is a clear demonstration of smart money looking past the short-term panic. And it is not an isolated event. There are clear indications of cluster buying at these levels. Institutional investors recognize that the 2026 guidance shock is a temporary cyclical pressure, and they are using the massive retail sell-off to acquire shares at a discount. They are focusing on the underlying fundamentals and the upcoming catalysts.
That brings us to the final investment pieces. Based on all the synthesized data, the bullish score for this asset right now is a 7 out of 10. Let's outline the 4 major pillars that support that strong 7 out of 10 rating.
The first pillar is the oral pivot. The company is preparing to launch oral Wegovy. This is a vital strategic move because it directly counters the physical barrier of weekly injections. A significant portion of the global population suffers from injection fatigue or needle phobia.
Nobody likes needles.
Right. By offering the exact same efficacy in a daily pill, they instantly expand their total addressable market. Crucially, it also neutralizes the emerging threat from competitors like Viking Therapeutics, who are trying to enter the market purely on the convenience of an oral option.
An oral pill fundamentally changes the accessibility of the treatment. That is pillar 1. Pillar 2 involves the label expansions we discussed earlier.
The massive potential of the MASH approval. As established, securing FDA approval to market the drug as a critical, life-saving organ treatment rather than just a weight management tool unlocks mandated insurance coverage. That single indication could exceed $1 billion in new sales, providing a massive buffer against U.S. pricing pressures.
Pillar 3 focuses heavily on their upcoming pipeline catalysts. They are rolling out a higher 7.2 milligram dose of Wegovy for enhanced efficacy. But the more speculative catalyst is the acceleration of phase 3 trials for a drug called zenagamtide. The industry is quietly referring to this as the oral lily killer. How does zenagamtide actually function to earn that reputation?
Zenagamtide is what we call an oral coagonist. Eli Lilly's current injectable advantage comes from targeting 2 different hormone receptors simultaneously, which produces slightly more weight loss than targeting just the GLP-1 receptor alone. Zenagamtide is designed to replicate that dual receptor targeting, but in a pill form.
Wow.
If they can successfully bring an oral coagonist through phase 3 trials, they could potentially match or beat Eli Lilly's efficacy without requiring the patient to ever use a needle. Accelerating this trial shows they're playing aggressive offense.
That leaves the 4th and final pillar, which addresses the geographic revenue split.
The global offset. And this is how the company survives the 2026 U.S. margin compression.
Yeah.
While the U.S. market is being dragged down by government negotiations and Medicaid cuts, the international volume growth in GLP-1 adoption is exploding. The rest of the world is just beginning to scale these treatments.
And they have the factories to meet it now.
Yes. Thanks to the Catalent acquisition, the company now possesses the physical global manufacturing infrastructure to meet that surging international demand, which is perfectly positioned to offset the U.S. pricing drags.
If you are looking at this 7 out of 10 bull case, how should you frame the timeline? We are looking at a target horizon of 2026 to 2028, making this a multi-year hold, correct?
A multi-year hold is the only rational approach here. This is not a scenario for quick momentum trading. You are intentionally buying during a period of maximum pessimism and holding through the construction phase. You have to wait for the multi-billion-dollar integrations to transition into streamlined operational efficiencies and for massive pipeline readouts like Zenagumtide to mature into commercial products. The 2026 headwinds are undeniably real, but they are identifiable, quantifiable, and already priced into that 18% drop.
You are buying the factory while it is being renovated, waiting for it to start producing at full capacity. As we wrap up today's analysis, I want to leave you with a final thought to mull over. As we watch these pharmaceutical titans battle over pricing contracts, pipeline readouts, and telehealth regulations, consider this broader perspective. When a single company vertically integrates to own the entire journey of human metabolic health, from buying the actual factory floor to delivering your daily dose to save your liver and your heart, are we simply investing in a drug, or are we investing in a fundamental shift in global healthcare infrastructure?
It represents a structural paradigm shift in how we manage population health, without a doubt.
Thank you so much for joining us for today's wealth building analysis. We appreciate you taking the time to explore the markets with us, and we will catch you on the next one.